Hello everyone, my name is Fabio Fabiani. I'm an EY partner and I lead EY's financial instrument technical accounting team in the UK. Today I'm at our EY office in central London with a great panel of experts to talk you through the IASB's exposure draft on risk mitigation accounting. This is the new name of the dynamic risk management project from the IASB. The exposure draft was just issued in December 2025 and it represents a major milestone in the world of hedge accounting. I'm joined today by Jane Hurward, David Bradbury and Tom Hampshire, who are all EY partners also based in London. About 1 year ago, we hosted a panel discussion on this topic, focusing on the key proposals of the model, which are largely unchanged in the exposure draft. Today, we'll be focusing primarily on the IASB request for fieldwork, which accompanies the exposure draft, and our panelists will be sharing their thoughts and observations. Jane, to kick us off, can you give us some background to the exposure draft and the IASB request for fieldwork?
Yes, of course. Hello, everyone. The IASB published the Risk Mitigation Accounting Exposure Draft in December 2025, with feedback requested by the 31st of July 2026. The IASB's proposed new model is designed to better represent the economic effect of an entity's risk management activities if the entity manages interest rate repricing risk on a net basis using derivatives. Alongside the exposure draft, the IASB has also issued a request for fieldwork. This means that entities are asked to test the proposals against various scenarios to see how the risk mitigation accounting model would work for them in practice and then to provide their feedback.
Thank you, Jane. That's helpful. You mentioned that the model is meant to be used by entities that manage repricing risk on a net basis by using derivatives. Can you explain what you mean by that?
Yes, of course. Repricing risk is a type of interest rate risk that exposes a company to variability in both cash flows and fair value of financial instruments. This risk arises from differences in the timing of when financial instruments reprice to benchmark interest rates, and also the amount of financial instruments that reprice in a particular period. A bank that has a large portfolio of fixed and variable rate loans funded by a variety of sources, including fixed and variable rate deposits, typically manages the inherent repricing risk on a net basis. The net repricing risk, which is also likely to include future transactions, is usually aggregated across different time buckets in order to measure the repricing risk. And this is with a view to managing the risk accordingly to assigned risk limits.
And how is this dealt with by the new model?
The new model is designed to represent the economic effect of an entity's risk management activities and is very different to the existing hedge accounting alternatives, which don't accommodate designating net repricing risk and also preclude certain hedge exposures from being included at all or in a manner consistent with risk management. Under the proposed risk mitigation accounting model, exposures can be included on an expected repricing basis according to behavioural models and in line with risk management. In addition, the eligibility criteria for exposures is wider than existing hedge accounting, such that additional exposures, including demand deposits, can be incorporated. Further, the new accounting model also reflects the net nature of risk management, as it avoids the need for any gross designations and related proxy hedges currently applied. This should result in more transparent financial reporting for this type of risk management activity.
Understood, thank you. And is the new model just relevant for banks?
Banks will be most affected, and the model has been mainly developed in response to discussions and feedback from banks. However, they are not the only type of entity that could potentially benefit from it. Insurance companies often manage interest rate repricing risk on a net basis, and large corporates may have significant treasury portfolios comprising investments funded by issued debt, so they too might benefit from using the model. These entities should review the exposure draft and assess whether they are within the scope of the model, whether it would work for them, and how it might be improved for their purposes. The model is nonetheless voluntary. However, if an entity is in scope, they are caught by the new disclosure requirements, even if they choose not to apply the model. We are going to discuss those in more detail later.
Thank you, Jane. That's helpful. David, I understand the model has been under development for quite some time. Can you talk us through the key elements of it?
Yes, of course. This diagram provides an overview of the model elements as described by the IASB. I'll briefly go through them in turn. On the left of the diagram, the net repricing risk exposure results from the interest rate repricing risk arising from the entity's underlying portfolio of financial assets and financial liabilities, including forecast transactions. Moving to the centre of the diagram, the risk limits are determined by the entity's risk management strategy, which influences the risk mitigation objective, representing the risk that the entities want to mitigate. They achieve this by entering into external derivatives that are traded in the market, which evidence the risk mitigation objective. On the right of the diagram, the benchmark derivatives are constructed for the purpose of measuring the extent to which the risk mitigation objective is achieved, similar to a hypothetical derivative under current cash flow hedge accounting. This results in the recognition of the risk mitigation adjustment as an asset or a liability for which the present value changes mitigate the fair value gains and losses arising from the designated derivatives. If the designated derivatives fully mitigate the risk as expected, this means that there should be no net P&L impact from their remeasurement. However, P&L volatility may arise over time, for example, as a result of unexpected changes, and we're going to talk a bit more about that later. When the mitigated risk as defined by the entity affects the income statement, the risk mitigation adjustment is released.
Thank you, David. The key elements of the model seem reasonably clear. Can you explain why the IASB request for fieldwork is so important?
Absolutely. The new model is principles-based. This is to allow entities flexibility to apply it to best reflect their risk management approach, which may be different between entities. The model is potentially complex to apply, reflecting nuances of entities' risk management. Some of the elements will already be present in their risk management activities, but some are different and new for the model, such as the benchmark derivatives and the risk mitigation adjustment. The results from the fieldwork will provide the IASB with information on how the model could work in practice. If there are aspects that could be improved or clarified, the IASB wants to hear about them. They also want to understand the costs and operational challenge the model may pose and whether it will improve how entities communicate in the financial statements how they manage interest rate repricing risk.
Thank you, David. Can I now ask for something different? If the new model was finalized as proposed, will there be impact on other IFRS accounting standards?
Yes. The IASB plans to withdraw the IAS 39 hedge accounting requirements because IFRS 9 will then be complete and IAS 39 should no longer be required. The only hedge accounting available once the risk mitigation accounting proposal becomes effective will be IFRS 9 hedge accounting. IAS 39 hedge accounting covers micro-hedging relationships, that is one-to-one hedges, and also macro-hedging relationships, i.e. portfolio hedges. The withdrawal of IAS 39 has relevance to entities that will not apply the new model, including those that currently apply IAS 39 micro-hedging. Also in the UK and European Union, entities can apply a carved-out version of IAS 39, which will cease to be available once IAS 39 is withdrawn from IFRSs as issued by the IASB. So although currently those applying the carved-out version of IAS 39 can achieve hedge accounting for demand deposits, that will no longer be the case unless they apply the new risk mitigation accounting model. Whether or not entities expect to apply the new model, they should anyhow identify whether they would be affected by the planned withdrawal of IAS 39 hedge accounting.
Thank you, David. Tom, you have already been involved in some fieldwork project with some preparers. Can you share some lessons learned and insights that you've gathered from your involvement so far?
Yes, sure. As Jane mentioned, the exposure draft and the request for fieldwork were published in December 2025. The IASB asked to receive initial results of the fieldwork by the end of July 2026, which is also the date when comments on the exposure draft are due, but final results can be submitted up until the end of November 2026. This means entities had a year to run the fieldwork from when the request was made.
That sounds like a good length of time, which probably speaks to the complexity of implementation of the proposal. Can you describe how an entity might organize itself for the fieldwork and what should ideally prioritize?
Of course, I think the project can be split into 6 main phases or steps. The first step is to mobilise resources. This includes identifying an appropriate sponsor who is ultimately accountable. This will likely be someone from the Treasury or the finance function. They will ultimately set the scope and objectives for what they aim to achieve from the fieldwork. A project team with appropriate governance can then be formed. This requires a working group that includes members from finance, risk, Treasury and technology teams. The governance over the working group should be well defined, including frequency of meetings, responsibilities of members, and the process for reviewing and approving recommendations made by the working group. They then develop and agree a project plan describing the activities and the timing for their completion.
When would you expect the entities to finish this first step of the programme?
Ideally, they would have mobilised resource during Q1 2026. Realistically though, entities with a December year end may have been occupied by other activities for most of Q1. If they have not mobilised by then, it is not too late, but the sooner the better.
I see, that makes sense. What should happen next?
Once the project plan is agreed, the design phase kicks off, which is when entities start to work out the detail of what to do and how to do it. Members of the working group should read the exposure draft to build their understanding. The working group should document how they interpret the proposals and note the assumptions they plan to apply. Entities may benefit from participating in industry group discussions and engaging with their consultants and auditors to check their understanding is consistent with others. In this phase, entities will determine which scenarios to use to test the model and what outputs they will need. Additional data requirements or new tools will be identified. If entities do not have the capacity to build the tools in-house, they may outsource this to a simulation tool provided by a third party. EY, for example, has a tool that could be used for this purpose.
Can you check if there's any expectations from prudential regulators that entities should consider in this phase?
Yes. Prudential regulators for banks, at least in some jurisdictions, are keen to understand how the model could interact with their financial stability objectives. The 6 scenarios described in the IASB's request for fieldwork include examples of liquidity and credit stress. So when testing the model, banks should avoid only focusing on simple interest rate shifts, which is one of the IASB scenarios. Also, regulators are keen for banks to assess the regulatory capital impacts of these scenarios.
That makes sense. Those are all crucial aspects to consider, and by the end of the design phase, entities should be able to tackle the fieldwork, right?
That's right. The design phase is crucial. Next comes the build phase, which should happen during Q2. The entity identifies, sources, and prepares the data that will be used to perform the fieldwork. This requires entities to develop their own tools in-house or to onboard a new tool, such as one provided by a third party. They will also need to test the tool to ensure it performs in line with requirements.
And with this step complete, the entity is now ready to produce results, right?
Yes. Next comes the execute phase, when the entity runs the various scenarios and starts to review and analyse the results, which are shared with the IASB in the respond phase. The test can be amended and rerun as required, depending on whether the output was satisfactory. The execute and respond phases can be run in 2 stages to align with the IASB's timetable for feedback. They have requested initial results by the end of July 2026, so the first run could take place during June and July. This run should focus on the priority areas and will help inform entities' comments on the exposure draft. Then in Q3 and Q4, further runs can take place to explore in more detail any problem areas identified in the first run and further stress scenarios ahead of the November deadline for final results.
That's a very clear progression of activities. Thanks, Tom. And by the submission of results in November 2026, that's when the project can be wound down. Is that the end of it?
No, that wouldn't be a good idea. Whilst the fieldwork will be completed during 2026, in 2027 and onwards, the IASB will be reviewing and analysing the results of the fieldwork and rediscussing their proposals. They will likely be reaching out to respondents to discuss the results, and the model will continue to develop. It's therefore important for entities to stay engaged with the process. Also, during this time, the entity should complete the documentation of the impact assessment for internal purposes. This includes which systems and processes will need to be updated before the model takes effect. This is especially relevant if the fieldwork has used offline tools and workarounds to produce results, as is likely to be the case for many entities. This represents the plan phase, when the entity is preparing for implementation. It also requires any technology development to be appropriately planned and scheduled in advance of the new model taking effect.
Thank you, Tom. That's really helpful and provides a great insight into how the fieldwork should be run. Jane, David, you've been involved in a number of discussions so far. Can you describe some of the trickier aspects of the model identified that the field test will help to explore?
Absolutely. One of the first challenges is on what can be included in the portfolio of financial assets and financial liabilities that comprise the net repricing risk exposure. This is shown on the left of the diagram. Under the IASB's proposals, entities are not permitted to include instruments classified as equity in the model. This is because, for accounting purposes, equity represents the residual of the entity's assets and liabilities, and it doesn't bear any interest rate risk. Nevertheless, it is relatively common for banks to model the interest rate risk they associate with their equity instruments for risk management purposes. So, whilst it is clear that the equity instruments themselves cannot be included within the model, it is permitted that modelled equity, based on risk management, can be used as a proxy to determine the repricing risk arising from variable rate financial assets not funded by financial liabilities. Examples of how this might be done are provided in the exposure draft, but these are only suggestions and other approaches may be acceptable. Exactly how entities choose to include modelled equity within the net repricing risk exposure will be a key judgment as part of the fieldwork.
I see. That's going to be an important area for entity to consider during the fieldwork. David, can you suggest any other areas?
The model is intended to align with banks' risk management practice and proposes the allocation of the open net repricing risk exposure to time bands. Many banks manage their net interest rate repricing risk using time bands, but not all do. For example, some might use a duration-based approach, where repricing risk is mitigated based on duration rather than per time band. As part of the fieldwork, entities should explore whether the model can accommodate their risk management approach.
Thank you, David. Jane, are there any other areas of judgment that you would like to highlight?
The new model allows for exposures to be included that may not previously have been directly eligible for hedge accounting. For example, future transactions, such as banks' pipeline of future mortgages and portfolio of core demand deposits, can be included based on banks' modelled forecasts. This introduces new areas of judgment and estimation for accounting that weren't there before. Once the new model takes effect, there will need to be suitable governance over these judgments and estimations so that they are controlled and scrutinised sufficiently and also capable of being audited. As entities go through the fieldwork, they should note these areas, which will require additional controls, processes and governance.
That's important. David, anything more from your perspective?
Another area of complexity is how unexpected changes to the portfolio are identified and the process for updating the benchmark derivatives. This includes, for example, prepayments, impairments or sales that were not anticipated. In such case, entities must adjust the benchmark derivatives to capture the effect of unexpected changes that reduce the net repricing risk exposure to an amount equal to or below the risk mitigation objective. On the diagram, this relates to the activities noted on the right-hand side. The exposure draft does not specify how to update the benchmark derivatives, so entities must determine the method that best reflects their specific facts and circumstances. Additionally, unexpected changes to the portfolio may result in reducing the value of the net repricing risk exposure to below the value of the risk mitigation adjustment. If there is an indicator this might be the case, entities are required to run a test, and if there is indeed any excess of the risk mitigation adjustment over the net repricing risk exposure, this must be released to profit or loss. During the fieldwork, entities should assess whether the excess test, including the method elected to measure it, provides a suitable means to measure the risk mitigation adjustment and remains appropriate.
Thanks, David. Jane, what about the first time the model is going to be implemented? How's that going to work?
Entities applying IAS 39 hedge accounting will need to transition to IFRS 9 as IAS 39 will no longer be available. As stated before, this applies for any micro and macro hedges, as all IAS 39 hedge relationships will have to be discontinued and IFRS 9 applied prospectively. Entities that previously applied IFRS 9 hedge accounting but want to move some exposures and hedging instruments into the risk mitigation accounting model can do so. They can also revoke previous fair value option designations if those exposures will move into the new model. For hedge relationships under IAS 39 or IFRS 9 that are discontinued when the model is adopted, any hedging adjustments and reserves continue to be recognised or amortised in line with the normal requirements for discontinued hedging. During the fieldwork, entities will need to understand which hedge relationships they will discontinue and which will be moved into the new model. As currently proposed, on transition to the model, benchmark derivatives must have a fair value of 0. This could give rise to problems where on transition the designated derivative have a non-zero fair value, potentially creating a mismatch in measurement that will be realised over time through P&L. This is another area to consider the implications of within the fieldwork.
Thank you, Jane. David, we haven't talked yet about disclosures. Anything you want to share about them?
Yes, sure. Entities that apply the new model will need to disclose information about how they manage repricing risk in line with their risk management strategy and how their risk management activities affect the amount, timing and uncertainty of cash flows. This will comprise qualitative and quantitative information. The new model is optional, so there may be entities eligible to apply it but choose not to. They'll still have to provide qualitative disclosure of how they manage interest rate repricing risk and how it's represented in the financial statements. The proposed scope of the amendments means the new disclosure applies to most banks and perhaps some insurance companies and also large corporates that choose not to apply the new model. During the fieldwork, entities should start to assess how to gather the information needed and what is going to be the most helpful for users of the financial statements and provide feedback to the IASB on what is proposed.
Thanks, David, Tom, Jane. That was all very informative. That brings us to the end of this video. We hope you find it helpful to introduce you to the IASB's request for fieldwork for the proposed risk mitigation accounting model, explore some key questions and challenges, and suggest how entities may tackle some of them. I should add that there are certain aspects of the model, including some of those that we mentioned today, that are particularly complex or judgmental. The IASB has recently issued some educational material, and we plan further and more detailed guidance from EY to follow as well. In the meantime, if you would like to discuss any aspects of what have been covered today, please reach out to your local EY contact. Thank you and goodbye.